Today I wanted to talk a little bit about the gray area of independence. It seems the definition of independence in our industry is getting harder and harder to pin down. What used to be a clear choice, wirehouse versus independent, has become a complex web of deal structures, private equity ownership, and now even restructured private equity roll-ups and ownership. Private equity firms have poured billions into the RIA space, buying into firms that once prided themselves on being independent and conflict-free. Now, many independent firms have outside investors, layered equity, and centralized control. So it is fair to ask, how independent is independent anymore? If you're an advisor thinking about leaving a wirehouse and partnering with an RIA, but you're not really ready to stand up your own ADV, here are the top factors to think about. First, I want to set the stage for what your potential deal structure might look like and how you should be approaching it. Every advisor in our industry has been conditioned to focus on headline payout and upfront money. That's how the wirehouse and broker-dealer world trains us to think. But when you step into the independent space, the economics look a little different, but it's not always for the reasons that you might assume. In a traditional-based deal, you're not really receiving free money. You're simply selling your future payout in exchange for a check today. It's a net present value trade between you and your employer. And the firms generally win that math every time. But in the independent space, you own your practice, or at least for this discussion, I'm going to assume that's the case. And when you're a business owner, the negotiation shifts. The deal is no longer about discounting your own cash flow. It becomes a business transaction. It's much closer to an M&A deal than a wirehouse retention package. This is the mindset shift that matters most. In independence, you're not pricing your production, you're pricing your business. Okay, first, the economics and valuation. Don't focus on the headline payout. Look at the real economics. Look at ownership, net compensation, expense management, profit participation, and true enterprise value. At a corporate RIA, you might earn a 60 or 70% payout, but under a partnership style model, you could own equity in the LLC. You could share firm profits and build an asset that can later be sold at a higher multiple. And the models can range in ownership, and participation can range quite a bit based on the firm that you choose to join. Okay, number two, autonomy and investment authority. Ask what level of discretion and product flexibility you're actually going to have after the transaction. In some corporate RIAs, trading and investment policy are still controlled centrally. In others, you have complete open architecture, meaning you choose the platform, you choose the custodian, and you choose the strategies. That's a major difference in how you serve your clients. Number three, tax structure, W-2 or 1099. As a W-2 employee, you're actually just an employee. Your firm controls your benefits, your payroll, and they get the deductions. As a 1099 employee, you're running a business. You can write off expenses, control retirement contributions, and structure income more efficiently. This is a core benefit of independence. That flexibility can make a six-figure difference over just a short amount of time. Number four, staffing and practice control. Finally, consider whether you control your team. Can you hire? Can you compensate? Can you build the staff around your client experience? Or does HR run it through a central office? This ability to shape your own culture is often the biggest differentiator between being independent in title versus being independent in practice. In closing, with the right structure, you can achieve the best of both worlds, autonomy, scale, and real ownership, without taking on unnecessary risk or unnecessary tasks that are going to slow you down from business growth. The independent space has evolved. It's not just black and white anymore. And in case you haven't been paying attention, it's not just a few small firms that wanted to leave the big ones. It's one of the fastest growing segments in the wealth management space, and the big money is chasing it. Name any large PE firm and then look to see what their interest has been in the space lately. Your practice sits squarely in the middle of a generational shift in the United States financial services industry. And you owe it to yourself, your family, and your clients to understand the models, the access to real wealth services, and the valuation story that is quickly evolving. I'm David McBee with Wealth Partners Alliance. And if you're curious about what model truly fits your goals, I'd be happy to talk to you or your team and talk about the differences to help you build a plan that's right for you your family, and your clients.